and welcome to this podcast from the Private Wealth team at Safri. My name is Leonora Stevens, and I'm part in the Private Wealth team based in Bristol. I'm delighted to be joined virtually by Mike Hodges, a fellow Private Wealth partner at Safri. He's based in our Manchester office. Hello, Mike.
Hi, Leo.
Today, we are embarking on our second podcast relating to the impact of the budget that were announced on the 30th of October by Rachel Reeves. Our first podcast covered the main topics announced, such as inheritance tax and capital gains tax. But we looked mainly at the impact on the agricultural sector, which is where a great deal of the press attention has been focused on. Today, we're going to look more at the impact of the budget on family-owned businesses. This feels to be an area that's been rather neglected, but is an area that's hugely impacted by the changes. In conversations with clients, many seem to be under the impression that if they aren't farming businesses, they won't be affected. But this is sadly not the case. So the specific area of focus today is in respect to family-owned businesses relating to inheritance tax and the business property relief changes. And then we'll look at the cash flow and the issues that finance directors of these entities will need to bear in mind. I'll firstly cover off why does this matter? So you may be an FD listening to this thinking, why does it affect me? Well, pre-budget, there may have been a family-owned trading business which was set up by a mum and dad, and they had various different family shareholders in the mix. The plan may have been for mum and dad to gift their shares on death to the next generation. Pre-budget, if the shares qualified for business property relief, there would have been no IHT on death. But post the budget announcements and post April 26, there will be 100% business property relief on the first £1 million of value, then 50% relief on the value above that, effectively meaning a 20% IHT charge on the value of shares above 1 million. The impact of this is that there may be a greater risk of family businesses needing to be liquidated or sold after a shareholder's death to fund tax. Bearing in mind that the historic policy reasons for BPR was to reduce the risk of businesses being broken up due to succession and needing to fund the tax. Mike, what do you think the key things that business owners and their FDs should be thinking about post these changes?
I think there's a lot, Leo, and you make a good point about the focus on APR. And I happen to be in London today, and there are, I'm told, 500 tractors at Whitehall. So, and the farming community has really got itself out there, hasn't it? I think perhaps there isn't as natural a focus for family-owned businesses. So, lots to think about. As you've said, you're going from a regime where we would simply say, don't worry, you've got an asset that's 100% exempt from inheritance tax. That's great. Now, suddenly, the tax bill becomes quite significant, and just for ease of maths, £5 million business, knock off the first million, there's 4 million at 20% rate of tax. There's £800,000 of tax where previously there was none. So there's a lumpy number there. And funding it isn't going to be easy, because to start with, you can't go out and borrow in practical terms on the security of shares. So if you happen to be the executors or the next generation holding the shares, having inherited them, you can't go and borrow. A bank won't lend you against unquoted shares. They might lend the business the money, but that would be on the basis of a commercial proposition. So you're then saying, right, that's all well and good, but the money is then in the business. So you have to get it out of the business into the hands of the people with the liability. And that's coming back to your comment, FD, what do we do? The easy answer, and there is a bit of good news, the easy answer probably is to say, well, we'll buy back some of the shares held by the generation inheriting the next generation. And there is at least a kind of, it's not a concession, it's in statute, but you can treat that as a capital transaction. So capital gains tax at worst case 24%, rather than an income distribution akin to a dividend, which could be, give or take 40%. So that's helpful, but it does presuppose the business can just go out and raise money. So and that's not a given. The business has to look after its own affairs. So this is coming from outside, nothing to do with the business. It's a family liability. And if the business doesn't have that capacity or the ability to raise the funds, it's illiquid for whatever reason, then it's a real struggle potentially. So I think all you can do at board meetings, shareholders meetings, is start that discussion sooner rather than later. I know quite often we're saying don't leave it till it's too late. With BPR at 100% as we have now and for the next 15, 16 months, you could just sort of say, right, I'm going to leave that, because as long as you'd hit the 2-year qualifying period, you were great. Now you need to start thinking about and potentially factoring into the business cash flows an IHT liability coming up at some point. So think about it and discuss. Have you got immediate thoughts, Leo?
Well, no, I think you're right. We always say communication is key, and talk about that. I do think it is creating a lot of anxiety amongst older family members, where they might think they might not actually survive the 7 years, and now,
Yep.
passing down that family business is going to leave a big burden on the next generation. And obviously there is talk about, will they not change the rules, but for those over 80, will it be slightly different? And it's something that you should start the conversations now, if you haven't already, to try and work out what options there may be and whether that could be funded elsewhere. But as I say, I think planning is key, because where their people aren't quite so old, they could start thinking about giving away their shares now and start a 7-year clock. Because if they give it away now to direct gift to an individual, and as long as they survive the 7 years, there'd be no inheritance tax. But then, are they living off the dividends from those shares? Do they need that income? There's anti-forestalling rules whereby if you make a gift but still retain income from that gift, then the assets will still be in your estate from inheritance tax. So it won't have got around that issue. Another thing that people will need to talk about is the control. If they make the outright gifts now in order to avoid the inheritance tax further down the road, do they want to give up the control of their business that they've worked for the last 30 years to build? Are their children minors? Are they too young to take on the business? It's thinking about that, and also say how they would fund that inheritance tax if they want to retain it. Because it might be that they could get insurance, which would cover the inheritance tax on their death. If it's written into trust, then that payment from the insurer wouldn't be subject to inheritance tax on the death. They could do that. Or if they're slightly older, but it may be uneconomical, if that's the right word, if they were to then make a gift and then get some insurance to cover if they were to die within the 7 years. There's things that can be done. It's not completely dire. I say it all just needs a bit of thought. And the other thing I think also it's really important is a lot of people fear what the liability will be. But if you sit down and actually do the maths and work out what the tax is, sometimes it's not as bad as people think. So it's worth actually just working out what the issue is, and then you can start planning around that, because there may be options. There may be things that sort of are the sacrificial lambs, as it were, that can be sold in order to fund the tax. So it's worth thinking about that and expressing your views with your family. But Mike, would there be anything else that you'd be recommending to clients now?
I think, yeah, there are a couple of good points to that. I suppose first one, that for business property, if the qualifying period is 2 years, you might not be worried about 7 years. It might be 2 years for the recipient of the shares to qualify for BPR in their names. The biggest difference we have is the easy planning we have currently, die owning the shares, 100% inheritance tax relief and uplift for capital gains tax. If we're talking now in the 15, 16 months before these rules come in about giving shares, you give to an individual or give into trust, then you're not going to get that uplift. And that may be really valuable. If you created your company with £100 of share capital and it's now worth multi-millions, that multi-millions, I suppose if it's passing down generations, there may never be a trigger point. But if there is, you don't get that uplift and a lifetime gift. Yeah, so a couple of other things. As I say, gift into trust, I think once we've got the consultation document, and there is more consultation coming out, we're promised early in the new year, so we may have to revisit this and have a third podcast on the budget. As I've said, the gift that keeps giving, at least for tax advisors. And then I think there's going to be a lot of people looking at next generation now, in lifetime trusts now, because at the moment and for that 15-month period, you could give the whole away with no tax, because the BPR is at 100%. And then you will be looking at, in the trust regime, which gets very involved, but basically every 10 years you have a charge. And in the new regime, you will have the benefit of some business property relief, but something coming in. So potentially a 3% tax charge every 10 years, but at least you know when that's coming rather than, the date of death being an unknown, and 20% on everything over 1 million. And then a discussion we were having, and this gets a bit technical, around valuations. And potentially if you say, right, we've got a company, we've split the shares into small holdings, then you can apply a discount for tax purposes to those valuations. So you might be able to fragment value. That might not be attractive if, from a commercial perspective, because I've advised families in the past where you've got dozens and dozens of family shareholders, and they can become very unwieldy as a practical proposition. You try to advise too many different people there. It might be something that you can think about. And I guess the other thing that is, again, more work for advisors, with 100% business property relief, you didn't worry about valuations. And HMRC would say, don't worry, that's covered by relief. Now, with real tax to pay, the valuation people in our firm, Leo, and at HMRC are going to be busy, because the tax is there to be paid and values need to be negotiated and agreed. And there is no such thing as one value for a company shares. So that's going to be another source of some angst. And again, I suppose you're in the territory of taking advice and trying to work out what your particular circumstances look like.
Yeah, I think that the other thing also to think about is, obviously we're saying family-owned businesses. It depends on what generation we are looking at.
Yes.
So if you mentioned earlier, when you and I were talking about this before we recorded, if you have a serial entrepreneur who's built up a lot of wealth within his business, and he's ultimately going to sell the business and have cash anyway, upon sale, he would have gone from a IHT qualifying asset to then 100% non-qualifying, i.e. it would all be subject to inheritance tax.
Yeah.
So if the ultimate aim is, I'm going to sell it anyway, and you'll have the IHT, but then on the flip side, you'll have a liquidity event in order to fund any inheritance tax.
Yeah.
Should you need to, then you have the other side of the coin where you've got multi-generational family business that's passed down the family for years, and it very much wants to be retained within the family. I think that is a situation where a lot more thought and consideration needs to be given, because they don't want just a fire sale to sell the lowest bidder or highest bidder to get the cash.
No, you're right. And we're recording this the day after the story broke about government spending £1,200 on 2 leather folders. And me being a bit of a stationery nut, thought I'd never heard of Barrow, Hepburn and Gale, who make these things. So I've been on their website. There is nothing for the average consumer, but they do make government boxes and boxes for the royal family, sort of the red box. The point of me raising this, other than to express my love of stationery, that business was founded in 1760. I haven't checked whether that's still in the same family ownership, but those are the businesses we're talking about. So no longer can you say, right, current generation is able tax-free to pass that business down to the next generation or the next generations, because there's a tax bump in the road coming up. And it's those sorts of situations that we're going to have to think about with our clients.
It's going to be interesting trying to work. As I say, every situation will be different. I mentioned this on the last podcast, but I think it's really important for people to start looking at their wills to see, is there liquidity elsewhere within an estate to fund any potential tax? There's also the balancing act. Do you start keeping a pot of income or cash that you put aside to think that will pay for the tax, the IHT on death, but then when you die, that will be subject to the 40% as well. So are you sort of grossing up with that in mind? But as we've also summarised before, I think the key is don't rush into anything. We've got time to plan, and we just need to get the finer details in as well to see whether there is anything that can be done. But here's conversations should start now, and FD should start thinking about how they might provide liquidity for the shareholders. Mike, have you got anything else further to add on that?
No, it's those discussions. It's cash and everything else. I know one of the quotes from government ministers have been around, you've got 10 years to pay the tax. But even on, on my example, £80,000 a year is no trivial amount to find in excess of everything else. And at a time where you're trying to deal with the estate. So all you can do is do some rough numbers, work it through, talk to everyone, which is, the constant message we bang the drum on, and make sure you have got a plan out there. And I've used the word lazy because I think there's 100% relief with business property relief as it's been historically and is still now. We've perhaps got a bit lazy and just because you don't have to think about it. You could just say that's sorted. Let's worry about everything else. Now we've got to bring in the value of the family business into our thinking in a way that we didn't before. Interesting times and still potentially, but I'm not holding out great hopes, potentially some messing around the edges, I suspect, when we get more news next early in 2025, which is now less than a month away, isn't it? So
Yes, well, agreed. Interesting times, and we shall keep our listeners updated on anything of relevance that comes through. But thank you, Mike, for joining me today. We work with a wide range of clients. Many are UK-based and many live overseas but have interest here, whether that's property, business interests or investments. We advise individuals and families on how best to safeguard, maintain and enhance their wealth and on the most appropriate methods of passing on that wealth to the next generation. We also help people comply with the tax laws in the UK, which can be complex. If you'd like to find out more about the services we can offer at Safri, please visit our website at www.safri.com. However, it is important for me to stress that if you're considering any of the topics discussed today, you must always take professional advice based on your individual circumstances. Thank you for listening.